stocks discussed on Phil's Gang are not in any way a recommendation or solicitation to buy, sell, or hold. If considering acting on information presented, we first recommend you seek out a competent, licensed professional for advice. Get ready for the radio show that tells you what Wall Street doesn't want you to know.
Oh, I'm a money magnet. Money, money, money's coming to me. Money sets me free. I'm a money magnet. Money, 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 money's coming to me.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Radio Network. With your host, Phil Grande.
Good afternoon, gang. Okay, a lot to talk about today. First of all, I want you to understand what's going on with this 10-year Treasury yield. But before I start with that, okay, here we go. I show every morning my members, okay, that one of the most important charts I use is I call my Pro 3 that I designed so that, because I like to see every morning before the market, or when the market opens, if a stock can hold its opening high, or by 5 after 10, I want to see if the stocks that opened on the high hold it, or are they making a new low by 5 after 10. We really don't start trading till 5 after 10 because everything settles down and you can see what's going on here. For example, I just want to show you this, what's going on today. Look what's going on with the mags, how strong the mags have been. But let's look at today alone. Today, if you look at the chart, this morning when it opened, it hit a high of around $65.73. And then it hit a low this morning on the open of about $65.15. But the rest of the day, it never made a high. It never made that new opening high. It made a new opening low. It broke its opening low, which tells you the stock for that day is not attractive, something you wouldn't want to add to, okay? Very, very important on the opening. But my point is that everybody is looking at this 10-year Treasury yield, okay, and just not thinking, actually. What's happening is they're forgetting that last year at this time, we had a situation that the 10-year Treasury yield, if you take a look at my chart here, the 10-year Treasury yield, it was in September 2024, was at 3.6%. I don't know if I can widen that or not. You can probably see it. But anyway, September 2024 was 3.6%. Now, that was the rate on the 10-year Treasury yield. And so we had the cut of 50 basis points. That's the Fed cut. And they wanted the Fed thought that the 10-year Treasury yield would follow and would drop. And that would take the pressure off interest rates. That would increase consumption. People would start buying cars again, houses, all this stuff. Well, he was wrong. The bond market's a great thing because the bond market's a truth teller. And the bond market said, no, we got to raise rates. So the tech stocks do not like high rates. Remember that. The tech stocks, they borrow a ton of money because they're innovative companies. They build products. It takes a long time to get it out. So it takes a long time, which means that their earnings are not immediate. Their profits, their valuations are immediate, like all the other companies. They're way out in the future. That's the difference with tech. They're way out in the future. And when you have to borrow a lot of money and the yields start going up, that really affects out in the future. And it can hurt those stocks. And especially when you're borrowing a ton of money, remember the dollar's going down in value, not up in value. So earnings, valuations, I mean, it can affect them big. So here's what happened. So last year, when we had the 10-year Treasury yield at 3%, let me get you the right number. The 10-year Treasury at 3.6%. The tech stocks were rallying. And so the market went up from September 2024 to February 2025. We had a rally in there. I'm not sure what I think it was around, I think it was about 15%, something like that. Maybe get that for me, Willie. But so we had a tech rally, 25% from September 2024, a year ago, to February 2025. We had, what did you say, about 20%? Yeah. A 20% rally with yields going up. What are you, nuts? Yields going up is very bad for tech stocks. Okay, you want yields going down because, again, they borrow a tremendous amount of money. Now, some tech companies don't, like Apple, but that's only one out of thousands of tech companies to even take the top 1,000. Okay, so it's very important that they can borrow cheaply. So, but why did the yields, as the yields were going up, and that was going to affect earnings, going to affect valuations, going to affect profitability out in the future. But yet these tech stocks kept rallying. But by the time we went from 3.6 low rates, and in February we hit 4.3, then guess what happened? The tech stocks, the market corrected. It went down 20%. It dropped 20% because we went from 3.6, okay, 3.6 to 4.8. Today, we're starting out not at 3.6. We're starting out today at 4.11, the 10-year. So wait a minute. So we got people who are buying tech stocks. Remember, it rallied from 3.6 in 2024 September to February 2025. We went up 20% because the rate started out at 3.6. And then when we got to February 2025, it was a 4.8. And that's what, 80, 90 points. Wow. They had that was pretty big. But when it hit that 4.8, the market dropped 20%. Dropped 20%. It couldn't hold it. So here, people are getting in again, but they're not getting in at 3.6. They're getting in at 4.11. And I said to my gang the other day when the Fed cut the Fed rate and the 10-year Treasury, which I predicted would go up, I said, we'll know by Wednesday how the tech stocks are going to be treated. Because if you got lucky last year and caught that 20% rally between September, a year ago, to February 2025, because you started out at 3.6. You got lucky. You had a low rate. But how are you going to repeat that? How are you going to repeat that when you're starting out at 4.11? I mean, that's remember, the market dropped when it hit 4.31, okay? The market dropped when we hit 4.8, I think it is. 4.8. So the market dropped when we hit 4.8. We dropped 20% with a 10-year Treasury at 4.8. We're starting out at 4.1. So how far can this market go when we start at 4.1? How much room do we have? We don't have the room that we had between 2024 and February 2025 when we rallied 25 points. We have hardly any room. So today we're starting to see tech stocks getting hit. And we're starting seeing money moving out of the tech stocks. And they're starting to go to value stocks. And the other thing that's going on is yields are rising. So when yields rise, you have falling stock prices. When yields rise, it tells you that you're going to have more rate hikes. It's telling you that you got higher interest. It tells you you got economic uncertainty. It tells you inflation's increasing. That's what rising yields tell you. So we have rising yields. And we had rising yields last year from 2024 September to February 2025. And that's why once we hit that 4.8, everybody bailed. They bailed out because rising yields tells you, yes, we got a possible market rally, but you got to be in value stocks, not tech stocks, because you're going to have falling stock prices. You're going to have rate hikes, increase inflation. That's what the bond yield tells you. See, the bond yield tells you the truth. Just like when Powell lied to us and he says the reason that he was going to cut the rates by a quarter point is to fix the labor market. I mean, to fix the labor market by telling us that corporations needed a rate cut very quickly. If we can get a rate cut to these corporations, they'll start hiring. That was a bull-faced lie. I talked about this last week. Because the factories and the companies, they don't need a rate cut. They need confidence. They need confidence. They need confidence in consumption. And everyone knows that the consumer is the middle class between 35 years old and 48, and he's tapped out. See, that's what they don't need a rate cut to hire. They need a healthy middle class. But we don't have a healthy middle class because the income, okay, all the money is going to the 1%. And I showed you that chart yesterday right here. And you can see that chart. So this is why what's going on. This is a whole different. Everybody who's jumping into these tech stocks right now, it's a different game than it was last September. And here, just to give you an example, I showed you this last week. The 1 percentile are making a fortune in the stock market. Look at this, making a fortune, 2 times, 3 times, whatever. Now you take the middle class, they're not making any money. They're not making any money. So corporations and manufacturers and companies are saying, look, the middle class, they're dying. They can't consume. They can't consume. Right now they're trying to pay on their credit cards. They're trying to clear up their delinquencies on their automobile, delinquencies on their rent. So it's a big lie when they're saying how he's going to fix the labor market by giving companies a rate cut that they desperately need so they can hire the folks. Well, that's not going to happen. Now, so my point is this. Do you really want to bet that these stocks, tech stocks, that rallied from 3.6 last year, September, same time, a year ago, and broke when they hit 4.8%, we had a 20% correction. Do you want to bet that we still can go up? I think that was, a 20% correction for September 2024 to February 2025. You want to bet that we're having another 20% rally? How could that be when we're already at 4.11? We're not starting 3.6. Now, who else is buying this stuff? Tech. The only way this tech market could keep going up, and who's wearing blinders? Who are the people that are buying these tech stocks when rates have already reached 4.11? And when we hit 4.81 in February 2025, we had a 20% crash. So who's got the blinders on? Oh, I don't care. That's the tourist investor who doesn't know better. He's buying all the tech stocks that the hedge funds and the institutions are dumping. And all these retail investors who still have credit lines, who are buying on margin, they're buying all this stuff up. This is worse than in dot-com days. But the common sense, you have to think and say, do you really want to bet? Do you really want to start buying some tech stocks when we're already at 4.1 and the market crashed 20% when it hit 4.8? When it hit 4.8 in February, this past February 2025. I wouldn't want that bet. Now, do you get out of the tech stocks? No, because we don't follow fundamentals. Our gang members, we follow the money. We follow the money. So as long as they're increasing the money supply, as long as they're giving credit to the tourist investors so they can keep buying and buying and buying tech stocks, we're going to keep our positions. But we're going to know when it's going to crack. 30 seconds. We're going to know when the market's ready to turn. We're going to know about a week or two before the market turns. And then we'll position ourselves to short. That's your insurance policy. You have to know by watching not the fundamentals of a company, you got to follow the money of the company. And when you start seeing insiders dumping like we're seeing now, and you're seeing hedge funds dumping like they're doing now, what are you kidding? And you see the, the hedge funds aren't dumping, CEOs aren't dumping because they think the market's going up, but the retail investor does. Join my gang, philsgang.com.
Want more information on this show? Go to philsgang.com or give them a call at 877-600-GANG.
At St. Jude Children's Research Hospital, we're fighting against childhood cancer every day. At the heart of this battle are our donors.
Most of us want to make some type of difference in the lives of others. St. Jude does miraculous work.
The fact that no one has to pay, it's a place where everyone is treated as an equal.
Everybody is welcome here, and it doesn't matter your religion or what part of the world you're from, all that is taken away. It just gives you some hope.
It's just a nice feeling to put your energy into something that really does genuinely make a difference in a child's life.
There's just no greater gift. If we have the ability to help, then we have a responsibility to help.
Finding cures, saving children. St. Jude Children's Research Hospital. Find out how you can help at stjude.org.
When making wise investment decisions, Phil Grande has some sound reasons you should join Phil's gang.
You know, when I started this, they asked me, okay, can you explain to people why they should join the gang? Gee, I thought about that. And I guess to make money. But more than that, to get good direction on which way the economy's really going. We get so much crap, so many lies, how great the economy is and how great the tech business is, and when it's not. The problem is we have too many people in Washington and in this industry that just don't tell the truth. The truth is everything. And here at Phil's Gang, we stick with the facts. We tell the truth. We make sure our members, are getting the best information, and our listeners, like you. We make that information available to you and make it simple and understandable.
Good investing means understanding how the stock market works. Join today at philsgang.com. Welcome back. Are you ready to make profits in the stock market? Why not check out philsgang.com or give us a call, 877-600-4264. Now, here's Phil.
And welcome back to Phil's Gang, my podcast. So here's the decision you got to make. If you are a buy and hold person, if you follow fundamentals instead of the money, you got to make a decision. If you're in tech stocks, you want to stay in when you have the facts in front of you. Fact, 2024, the 10-year Treasury was at 3.6, September 2024, 1 year ago. And 1 year ago, they dropped the Fed rate by 50 basis points, and the 10-year Treasury yield, instead of going down, which they thought it would, went up. So we had a 20% rally from September 2024 to February 2025, led by tech. Yields went from 3.6 to 4.8. When it hit 4.8, after a 20% rally, the market had a 20% crash because the rates at 4.2 high are just high, because tech stocks do not like high rates, because tech stocks have to borrow a ton of money. And remember, their valuations, their profits and earnings are judged out in the futures, not like most companies, which are immediate. And when you have yields rising and your valuations are way out in the future, by the way, when you borrow, and they borrow heavily, all these tech companies, when you borrow money, remember the dollar in value, purchasing power is going down, down, down. So the minute they borrow money, these tech companies are already losing money because the value of the dollar. So you got to decide, are you going to bet that we had a 20% rally from September 2024 to February 2025 when yields went from started at 3.6% and the rally stopped at 4.8 and crashed? Now you're not starting from 3.6 this year. You're starting already from 4.1. And remember, the crash came when the yields hit 4.8. So your decision has to be, are you going to take that risk, knowing that when we hit 4.8 in 2025, the tech stocks collapsed. The market collapsed. I mean, I don't mean tech stocks collapsed. All stocks went down, but the tech stocks didn't lead anymore. So that's a very, now, if you know how to follow the money, instead of following fundamentals, then you have and you know how to short, and you have those skills to follow the money, not the fundamentals, and to have the skills to short so that you'll identify a week out, 2 weeks out, that the market's going to turn and drop and you get set up to make a lot of money shorting, then you should stay in these tech stocks as long as they keep making new highs. If you don't have a skill to short, you can't identify within a week out or 2 weeks out that there's going to be a big reversal and you don't know how to sell short. That's a heavy bet that you're going to go and keep buying tech stocks today when the rate's already at 4.1. And last year we had a 20% crash when rates hit 4.8. I mean that's a bad deal. But anyways, so let's hear what the geniuses are saying, the bankers are saying. Listen to this garbage right here. This is Jamie Dimon.
What's going on with the consumer?
They're still spending money. Still a little bit different depending what income set they're coming from. They still have jobs, so consumers tend to react to that. So the consumers weaken, commons weaken, corporate profit is still up. There's a lot of different factors in the economy right now. It's hard to figure out what it all means, and I've always been quite skeptical of most forecasts for that reason. So we just have to wait and see.
No, we don't have to wait and see. You're a liar. We don't have to wait and see. Here, take a look at this. More than 6.5% of borrowers are at least 60 days late on their car payments. Look at this. Look at this. They're late on their car payments, for God's sakes, okay? And another thing that is going on is that construction spending is the biggest thing. You want construction spending because that's how our economy drives itself, with construction, housing, building, construction. We create all the jobs. But we're not creating jobs. Look at this. So again, another lie. Take a look at their jobs. Who's lying? Are you nuts? Look at this. Construction spending is just collapsing. It's going down the same way as it did back in 2008, as it did back in 1999 and 2000. Look at this. It's collapsing, construction spending. Also, they're saying how, here, listen to this guy here.
When you look at just the overall data in terms of jobs, it's undeniable in terms of just job creation. So, yeah, things actually feel very good today.
Oh, really? And jobs are doing very, very well? Come on. Are you out of your mind, you nuts? What a liar. These people are there on these financial shows. They're there to sell you, get you to feel good, to make you go consume. They can sell you a stock. Look at this. That's not what the government's saying. Job openings. Look at this, how they're collapsing. Look, job openings are collapsing. This is from 2022 right here. They're collapsing. They're not going up, they're going down. And here's another thing I'm going to show you. I mean, these people are just professional liars is what they are. Their job is to get you to consume. Their job is to get you to buy stocks, not sell short. That's the big problem we're having. And we have another chart, if I can find the other chart, where the income shows. Let's see if I can get my coffee talk up here. I'll get you another chart, which is amazing. Right here, let's take a look at this. Here we go, salaries and wages. Look at this. Now, salaries and wages, corporate profits are up 6.2 times, okay? And if you have the net worth of the top 1%, up 5 times. Okay, now if you take the net worth of the bottom 50%, they're about half Half of that. Are you kidding me? This is insane. And again, the top 1% have all the money. They've got all the money. So again, for them to say how great things are.
When you look at just the overall data in terms of jobs, it's undeniable in terms of just job creation. So yeah, things are actually feel very good today.
Yeah, very good today. Here, how about, here's another chart. Wealth gap. Look at this. Look at this. Wages and salaries. Look at this. Just tumbling. Just tumbling. Look at that. Then you got, I mean, everything they're saying is just a total bold-faced lie. They're not telling the truth at all. I have a couple more charts here I'll show you. You know how they tell you, let's see, look at this. We have, I gave you the job openings, and look at this. Oh, they're doing great. Consumers doing great. Look at the total household debt. Look at this. Just screaming. Look, are you kidding? We're at $18 trillion. Look how much we've gone up since 2000 and let's just go back here to 2008. 2008, we were about, what were we at that point? About 10 trillion? And now we're 18 trillion? People have no money. The middle class has no money. And look at this, commercial real estate. Oh, they keep that really quiet. Commercial real estate. Look at the delinquencies in commercial real estate right here. See, they don't want to show you these numbers. Look at this, commercial real estate. Look at this. Delinquencies, those are delinquencies. Those are delinquencies. Are you kidding? I mean, so again, and if you look at job gains, this is just job gains part-time. It's all part-time jobs. You can't get a good job. You can't go. They just got rid of 375,000 full-time jobs, replaced with 600,000 part-time jobs. This is insane. Look at the chart. So again, everything they're telling you is just a bold-faced lie. Everything. Okay? And you want to talk about the stock market? If you're in fundamental, if you're buy based on fundamentals, you're going to get hurt. If you buy based on where's the money going, follow the money. Remember, what's keeping the market up is stock buybacks. Corporations are the biggest purchasers of stock. No more institutions. Okay, no more hedge funds. They're dumping. Okay, they're buying gold. But look at this here. The S&P hasn't been this overvalued since the dot-com bubble. Look at this. Here's the dot-com bubble back here, and here we are today. Here we are today. But when you listen to these characters, right, every one of them, just bold-faced lie. They got to get you to buy. So again, here's Jamie. Oh, yeah, let me show you this. Here's overvaluations right here. Look at this. You want to see the overvaluation of the stock market? See, they never show you this. Here's the overvaluation right before the 1929 crash, right there. Right before the 1965 crash, right here, look at it. Okay, right before the 1965 crash, you can see it right there. The 2000 crash, we're above that today. Valuations are above the valuations that took down the 1929 crash, the 1965 crash, the 2000 crash. Our valuations are even higher than that. Oh, and by the way, they lie like hell too. Okay, when you look at what's holding up the tech stocks, it's the money supply. Right here, look at the money supply right here. That's holding up the tech stocks, not earnings, because the earnings are terrible. But they mask the earnings with stock buybacks. When you're doing 5 trillion, 6 trillion stock buybacks, you can say, boy, look at my earnings. They're doing terrific. No, they're not. You're masking them. They're fake. Because when you have earnings, when you buy your own stock, if you have 1,000 shares, and let's just say for the sake of argument, now you buy stock buyback, now you only have 500 shares. That means your earnings go up and push your stock price up because you have less shares, not because of sales. But they're not going to tell you that. They say, look at my earnings, they're really good. Well, what if you didn't do stock buybacks? What would your earnings look like? They would really suck. They'd really suck. So, and then you got the mortgage rates are no longer 3%. No longer 3%. 65% of households have mortgage rates at 3 or below. And they're not selling their houses. So that inventory is not coming on the market. So the average house right now, medium price house, is about $465, $470. And if you're a middle class person, 2 kids, you're between 35 and 48, and you make an average of 65 to 75,000, which they do, you can't buy a house. You have to have an income of $125,000 to buy a house. Median, what the average price is around, I think it's $435, something like that. But these guys are telling you these stories. Let's listen to their stories again. I just gave you the proof.
What's going on with the consumer?
They're still spending money. Still a little bit different depending what income set they're coming from. They still have jobs, so consumers tend to react to that. So the consumers weaken, commons weaken, corporate power is still up. There's a lot of different factors in the economy right now. It's hard to figure out what it all.
Unbelievable. Part-time jobs. Part-time, not full-time.
When you look at just the overall data in terms of jobs, it's undeniable in terms of just job creation. So, yeah, things are actually feel very good today.
Oh, really? Yeah, I just showed you the job openings. Jolt, that's what you watch. Don't listen to these job numbers they give you on the first Friday of each month. They're all lies. We found that out. They just had to knock off 1.5 million phony jobs, remember? They just got rid of them. Here, look at this is what you look at, jolts. So he's telling you, look at this, look how it's declining. Look how the jobs are declining. And this guy is telling you at the same time, jobs are good.
When you look at just the overall data in terms of jobs.
There's the data right here, look.
When you look at just the overall data in terms of jobs, it's undeniable in terms of just job creation. So, yeah, things are actually feel very good today.
Now, let me tell you what's undeniable. This guy's a liar, bold-faced liar. The jolts is the only number you should look at. That's the only number that tells you the truth. So I'm going to end with this. You got to make a decision. If you're going to stay in tech stocks, it's fine as long as you know how to follow the money instead of fundamentals, okay? It's fine. And if you know how to short, you got to know how to follow the money, you got to know how to short. Then you're going to go, then you'll be out before the correction. But you got to make a decision. Are you willing to start buying tech stocks at 4.1? When last year we started to buy at 3.6 and the crash happened at 4.8. That's the risk you got to take right there if you're going to keep buying tech stocks. I hope this helped you. Join my gang, Phil's gang. It's free for 10 days, and we'll teach you how to trade properly. See you on the charts.
Gang with your host, Phil Grande, on the Off the Wall Street Radio Network. Off the Wall Street Radio Network. Remember to visit Phil's website at philsgang.com. That's philsgang.com.